Hi everyone, it's Miguel again with another video in my 10 Common Wall Street Misconceptions series. This video is going to dispel the myth that market appreciation means that you can avoid dividends. So to explain market appreciation first, market appreciation is the process of stock prices increasing. If you buy a stock for say $100, and then it goes up to 200 and you sell it at 200, you get to keep that difference between the $100 and $200. It's also referred to as capital gains. However, there's a whole lot more money that you can make in the stock market than just by relying upon the stock price to go up or down, because a lot of companies really don't have that much control on what their stock price is doing. But what they can control is their dividend policy. A dividend is basically a cash check that a company sends you in the mail. And according to empirical data that was compiled by Dividend Investing for Dummies, they found that about 48% of the market's total return came from strictly dividends alone after they had been reinvested. So while there are plenty of people who try and trade stocks quickly and they try and become day traders or get involved in high frequency trading, they're really missing out on about half of the total money that can exist for your returns, just because they're only making money if the stock price goes up or down. But that means that if you're not going to be paying attention to dividends at all, that you have to be twice as good as the market average in terms of your ability to bring back a good total return if you're going to be neglecting 48% of your potential money. And most people just simply aren't that skilled. So I would strongly recommend anybody who is looking to invest, especially for retirement, to figure out exactly which corporations have a high dividend potential, either with their dividend yield or their dividend growth rates, to ensure that you are actually going to get the money that you need in retirement. Now I'm going to break down two definitions. The first one is the dividend yield. What a dividend yield is it's basically the percentage return that you will get after a year of dividends that they factor into the policy of the trailing 12 months, or what the last 4 dividend payments would have been, and they take the current stock price, divide it by the total dividends paid, and you'll basically get a dividend yield number. It'll tell you the percentage return of how much you will reasonably expect to make within a year based off of dividends alone. And if you can look for corporations that have high dividend yields, then you're going to be able to get a significant amount of check money. However, the dividend yield isn't the only important thing to look at. You also want to make sure that you've got a high dividend growth rate. And there are a lot of places you can check out online. Dividends.com is usually where I get my data from. But I'll be sure to include some links inside of the bar that's above the comment section that has sort of the description of the video, just to give you some more resources on where you can look to learn about dividends. So dividends are usually a check that a corporation pays out to you. It's a share of profit that they feel that if somebody invested in a company, they're entitled to a cut of the profit. Whatever the board of directors decides to pay out, those are dividends, and they're usually paid out either in a quarterly or monthly basis, although sometimes if a business has like a really profitable season or something, they might decide to have what's called a special dividend, but those aren't too common. Normally, it's just going to be quarterly or monthly, and it's check money that gets sent to your trading account, and you can either spend it or you can reinvest it. I personally would recommend reinvesting it by setting up what's called a dividend reinvestment plan, also known as a DRIP. And if you don't think that a 3% return is going to mean much on your money, well, I actually put together 2 scenarios that show the difference that dividends can make. So the first scenario is a person who starts investing when they're 25, they have $1,000 to start, and they contribute $200 a month. That's about 10% of your income. And from a very famous book called The Millionaire Next Door, they basically said that there were 2 major factors that entitled for people to reach millionaire status. They found empirically that overwhelmingly, people who became millionaires usually followed 2 principles. First, they invested 10% of their income first They actually added to an investment account before they paid their bills, before they did anything else. They put away that 10%. And secondly, most millionaires actually only eat out about once a week. They're really good at eating at home and at cutting down unnecessary expenses. So if you want to get on the millionaire track, just by investing 10% of your income first and only eating out once a week can do a significant amount to get you to your desired financial goals. So with the first scenario, as I said, invested from 25 to 65, $1,000 principal with $200 a month. Over 40 years, you'd be able to retire at 65 with $509,073.18. And that's assuming a 7% return from stocks, which is still a lot more conservative than what the historical trend has been, and 0 dividends factored in. But let's look at the second scenario, where you begin investing when you're 25 to 65, you have the same amount of principal to start, you invest $200 a month, which would be about 10% of your income, and that's actually a little bit lower than what Americans make when they're 25 to 34, based upon evidence that was compiled on 2015 from Motley Fool, which I'll also include in the section above the comment window so that you can get a good idea of what the average person can reasonably expect to make throughout their lifetime. But the only thing that was changed was including an average of 3% in dividend yield for your portfolio and a 3% growth rate for dividends. Both of these numbers, you can look up individual stocks at dividends.com, and it will not only tell you how long they've been paying a dividend, but their growth rates and their yield, which are important factors to understand when you're trying to monetize how much money you will get from this check money. So with the same timeline principle, contributions per month, and age window, they ended up with $712,731.13, assuming that the dividends kept up with inflation, which is the target inflation rate is about 3%, and having a 3% dividend yield to start. So a person could end up making, that's about 40% more money just by picking stocks that have a good dividend yield and a good dividend growth rate. Now, that's easier said than done, and you might be asking, Miguel, well, if you think that you can make a lot of money from dividends, where should I look? And there are actually funds or that track good dividend policy companies, and there are also indexes that are created by people, for example, Standard & Poor's. They actually put together 2 lists called the Dividend Achievers list and the Dividend Aristocrats list. I'll start with the Dividend Achievers. Those are companies that have had 10 years of consecutive dividend payments, 10 years of consecutive yearly increases, and a minimum of $1 billion in total trading value. And there's a couple hundred that are on that list. But I think that the even more impressive list is the Dividend Aristocrats, which in order to be considered a dividend aristocrat, they have to have been increasing their dividend payments by 25 years, 25 years of consecutive dividend payments, and a minimum of $1 billion in total trading value. I'm going to list the current constituents, but I'll also include a list, or a link rather, on the section aforementioned, just so that you can look at what the most recent dividend aristocrats or dividend achievers are, because sometimes they get added or taken away because they don't maintain that trading value or they don't maintain the dividend policy to be able to make these indexes. Both of these indexes have actually outperformed the S&P 500. So if you want to look for good places to start by looking for safe blue chip stocks that aren't going to go away but still have a good chance of outperforming the market, the first place I would say would be to look at the Dividend Aristocrats Index. And I'm going to list all of them right now, and they should be corporations that you are familiar with or you've at least heard of. It's Stanley Black & Decker, Sherwin-Williams, PPG Industries, VF Corporation, Pentair, Nucor, Brown-Forman, Hormel Foods, McGraw-Hill Financial, Genuine Parts Company, McCormick & Company, Franklin Resources, Target, Clorox, McDonald's, Cisco Foods, Cardinal Health, Aflac, Chubb Corporation, Cincinnati Financial, W.W. Granger, Archer's Daniels Midland, Sigma Aldrich, Consolidated Edison, C.R. Bard, Becton Dickinson & Company, Medtronic, Procter & Gamble, Emerson Electric, Abbott Laboratories, ExxonMobil, Leggett & Platt, Chevron, HCP, Lowe's, Illinois Toolworks, Cintas, Ecolab, Kimberly-Clark, Air Products and Chemicals, Colgate-Palmolive, Walgreens Boots Alliance, Automatic Data Processing, T. Rowe Price, Dover, Pepsi, AbbVie, 3M, Coca-Cola, Johnson & Johnson, AT&T, and Walmart. So these are all really big companies that they might not have as large of growth prospects for their size just because they've been around for such a long time. However, they are really good at maintaining those dividend payments. And the good thing about dividends is that if you have enough money in your portfolio, you can actually live off of the dividend payments, and you can actually pass off all of the money that you've made from your stocks without having to sell anything that you own to future generations, to charitable trusts, whatever you want to do after you die. And it will allow for you to much better maintain your cash flow because you'll be getting in those paychecks every quarter, which will allow for you to live off of them without having to sell the stock that you can spend however you please. So this video just wanted to touch base with the importance of emphasizing dividends, because if you truly want to be able to reach your financial goals, most people can't make it day trading. Most people aren't going to be getting the majority of their profits from buying something at 1039 and selling it at 1041. The main profits are going to exist by holding investments over the long term and reinvesting your dividends by setting up a dividend reinvestment plan to allow for you to buy more stock, to get more check money. The check money that you get will allow for you to buy more stock, and it will allow for more of the exponentiality of the cash conversion cycle to maximize your returns. Thanks again for watching, and be sure to pay attention to my next video, which will dispel the myth earnings reports tell you how fast a company is growing. Thank you.